Have you ever wondered how some investors achieve impressive returns without complicating their lives? Do you want to discover the secrets they use to grow their money quickly and effectively? Today, I'm going to reveal 5 investment strategies so simple that even a beginner can implement them. Did you know you might be losing money by not using these tactics? Imagine doubling your gains with simple and practical steps. Stay with me, and I'll show you how, because achieving financial freedom has never been this easy. Let's get started. Have you ever wished to invest like the pros, but without the hassle? Index funds are the answer. Imagine having a small piece of all the biggest and most successful companies in the market without needing to be a finance expert. Index funds do just that. First, what is an index fund? It's a type of investment fund that tracks the performance of a specific market index, like the S&P 500. This means that by investing in an index fund, your money is spread across all the companies in that index. You don't need to pick individual stocks or worry about the performance of a single company. It's like owning a piece of the entire market. Why are index funds so popular? Here are 3 key reasons. Automatic diversification. Investing in an index fund means your money is spread across many different companies. This reduces risk because you're not betting everything on one company. If one company in the index has a bad year, others that are doing well can balance out the loss. Low costs. Index funds generally have much lower fees than actively managed funds. This is because they don't require a team of fund managers to pick stocks, which means more of your money works for you instead of paying commissions. Solid long-term performance. Over time, market indices tend to grow. Although there are ups and downs, the overall trend is positive. This means that with patience, you can see your investment grow steadily. Suppose you decide to invest in an index fund that tracks the S&P 500. This index includes 500 of the largest companies in the United States, like Apple, Microsoft, and Amazon. With just one investment in this fund, your money is spread across all these companies. You don't need to worry about studying each company because your investment reflects the performance of the market as a whole. Imagine if 10 years ago you had invested $1,000 in an S&P 500 index fund. Today, that investment could be worth more than double. This is because the market has grown overall, and you have benefited from that growth without lifting a finger. Index funds are one of the simplest and most effective ways to invest. They offer diversification, low costs, and robust long-term performance. So, if you're looking for an easy way to grow your money, index funds are your best option. Would you like to receive extra income without having to do practically anything? Investing in dividend-paying stocks is your solution. Imagine that besides seeing your investments grow, you receive periodic payments just for owning shares of certain companies. This is what dividends can do for you. First, what are dividends? They are payments companies make to their shareholders from their profits. Basically, it's a way to share the company's success with its investors. These payments are usually made quarterly, although some companies do it monthly or annually. Why invest in dividend-paying stocks? Here are 3 key reasons. Regular passive income. By owning shares of companies that pay dividends, you receive regular income without having to sell any of your shares. It's like receiving a check in the mail just for owning part of the company. This income can be especially useful during retirement or for covering recurring expenses. Dividend reinvestment. A powerful strategy is to reinvest the dividends you receive to buy more shares. This is known as compound interest. Over time, your dividends generate more dividends, and your investment grows exponentially. It's a fantastic way to increase your wealth with minimal additional effort. Stability and growth. Companies that pay dividends are usually stable and profitable. Think about it. A company wouldn't be able to consistently pay dividends if it weren't well managed and generating profits. Moreover, many of these companies increase their dividends over time, which means your passive income also grows. Imagine you decide to invest in a solid and well-established company like Coca-Cola. Currently, Coca-Cola pays an annual dividend of about 3%. If you invest $10,000 in Coca-Cola shares, you could receive about $300 a year just in dividends. And that's not even counting the appreciation of the stock's value. Now, if you decide to reinvest those $300 in more Coca-Cola shares, next year you'll have more shares, which will increase your dividend payments. Over time, this reinvestment can lead to significant growth in your portfolio. Investing in dividend-paying stocks is a smart strategy to generate passive income, take advantage of compound interest, and benefit from the stability of solid companies. If you're looking for a way to get a steady stream of money while watching your investment grow, dividends are your best ally. Would you like to invest without having to worry about timing or market knowledge? Automatic investments are for you. Imagine your money working for you without you having to lift a finger. Thanks to technology, this is possible and very easy to implement. First, what are automatic investments? They involve using platforms that manage your investments automatically based on your preferences and goals. Robo-advisors are an example of these platforms. They use advanced algorithms to create and manage a diversified portfolio, adjusting it as needed. Why opt for automatic investments? Here are 3 key reasons. Easy access and use. You don't need to be a finance expert to start. Automatic investment platforms are intuitive and easy to use. You only need to answer a few questions about your financial goals and risk tolerance, and the system takes care of the rest.
If this video is opening your eyes to finance, hit like to support this channel and help us keep uploading more content. Comment on your biggest revelations so far and subscribe with the bell on so you don't miss any financial secrets. And if you have a friend or family member who could benefit from this video, spread the word by sharing it. Let's continue with more strategies that will change your financial future.
Professional management at a low cost. Robo-advisors offer professional management for a fraction of the cost of a traditional financial advisor. This means more of your money is invested instead of being spent on high commissions. Additionally, these platforms automatically rebalance your portfolio to keep it aligned with your goals. Time saving. With automatic investments, you don't need to constantly monitor the market or make daily investment decisions. This frees you to focus on other areas of your life while your money continues to grow intelligently. Suppose you decide to use a robo-advisor like Betterment or Wealthfront. You invest $5,000 and set up an automatic monthly contribution of $200. The platform distributes your money in a mix of stocks and bonds according to your risk profile. Throughout the year, the platform adjusts your portfolio to optimize your returns, all without you having to intervene. Automatic investments are an excellent way to put your money to work without complications. They offer professional management, low costs, and save time, allowing you to achieve your financial goals efficiently and stress-free. If you're looking for a simple and effective way to invest, try automatic investments. Would you like to generate stable income and capital appreciation through real estate, but don't know where to start? Investing in real estate might seem complicated, but with the right steps, anyone can do it. Let me show you how. First, why invest in real estate? Real estate is one of the oldest and safest ways to build wealth. It offers both passive income through rentals and long-term capital appreciation. Moreover, real estate is a tangible asset that can provide security in times of economic uncertainty. How to start in the world of real estate? Here are 3 key steps. Education and planning. Before making your first investment, it's crucial to educate yourself about the real estate market. Read books, take online courses, and attend seminars. Also, establish a clear financial plan that includes your budget, goals, and exit strategy. Start with small properties. You don't need to buy a large building to start. Small properties, like apartments or single-family homes, are more manageable and require less initial capital. Look for locations with high rental demand and good appreciation rates. Smart financing. Use mortgages or loans with low interest rates to finance your purchase. Take advantage of leverage, where you can control a valuable property with a relatively small initial investment. Also, ensure you have a financial cushion to cover unexpected expenses. Imagine you decide to buy a small apartment in a growing urban area. The apartment costs $100,000, and you secure a mortgage with a 20% down payment. After closing costs, your initial investment is about $25,000. You rent the apartment for $1,200 a month, and after paying the mortgage, taxes, and maintenance, you net $300 a month. Investing in real estate can be one of the best financial decisions you make. With the right education, careful planning, and selection of manageable properties, you can build a source of passive income and capital appreciation. If you dream of having financial security and long-term wealth, consider investing in real estate. Have you ever wanted to invest in the most exciting trends and sectors of the future? Thematic ETFs are your gateway. Imagine investing in sectors like green technology, artificial intelligence, or biotechnology, all with a single investment. First, what is a thematic ETF? A thematic exchange-traded fund, ETF, is a type of ETF that focuses on a specific theme or sector. Instead of investing in a broad market, these ETFs group companies related to a particular trend or industry. Why invest in thematic ETFs? Here are 3 key reasons. Exposure to emerging sectors. Thematic ETFs allow you to invest in high-growth, disruptive areas. You can benefit from the rise of new technologies, renewable energies, and other sectors shaping the future. Specialized diversification. Although you're focusing on a specific sector, thematic ETFs still offer diversification within that sector. This reduces the risk associated with investing in a single company. Accessibility and simplicity. ETFs are easy to buy and sell on the stock market. You don't need to select and manage multiple individual stocks. With a single investment, you can access a portfolio of innovative companies. Suppose you decide to invest in a thematic ETF focused on green technology. This ETF includes companies that develop renewable energy, energy storage technology, and energy efficiency solutions. With one investment in this ETF, your money is spread across leading companies in a sector with enormous growth potential. Consider the thematic ETF of robotics and artificial intelligence, which has seen significant growth in recent years. Investors who bet on this ETF have reaped great benefits as the demand for automated and AI technologies has surged exponentially. Thematic ETFs are a fantastic way to invest in the most promising sectors of the future without complications. They offer exposure to high-growth areas, specialized diversification, and are accessible to everyone. If you want to stay at the forefront of investments, thematic ETFs are your best choice. And there you have it. 5 easy and effective investment strategies that you can start using today to grow your money and achieve financial freedom. Did you enjoy the video? Don't forget to like and subscribe to the channel for more valuable content about investments and personal finance. Leave me a comment with your questions or topics you'd like us to cover in the future. And remember, the best time to start investing is now. See you in the next video.